last week I flew to Denver and then to Fort Lauderdale. This is on the way back. This is Southwest Airline. And if some of you haven't flown yet, this is what was happening. As you know, they are really want to make you feel comfortable flying. Uh, on one hand, it was wonderful. I mean, they're smiling, as you know, the sign says, and that's they they still do not feed you. They give you a little Chex Mix. They weren't doing that actually a week ago. They just started now. So you get a bottled, not a bottle, but a can of water with a straw. So that was good. But then they are using obviously less number of planes and smaller planes. So the flight I had from Fort Lauderdale to like Las Vegas, it was pretty busy. I mean, we still had some empty seats, and basically with the couples, you have the middle seat open, which is good. But I noticed that the flight attendants was she had gloves on, and she was cleaning in the back, and she touched everything from the trash that collects and then the cans they give you. And she walked in the middle aisle, and there was this like 3 or 4 year old baby, playing, and she goes and gives a high five to the baby. So sometimes all these, the precautions and, with like the mask on, which is fine. And a lot of people didn't have their mask on, by the way, on the plane. They took them off. But then, you touch the trash and then you touch the baby's hand, and the gloves are even worse than your hands. So sometimes we have to be careful. I mean, if there is really viruses that bad, it's not going to take a break for like the 2 hours during your flight when you're touching the kids. So these are the things that concerns me a little bit. I am happy that things are moving. When in Miami Beach, as I mentioned, I was there. We went fishing on the bay, and it was empty because of the storm. It was pouring rain. It was fantastic fishing, though. It was great, but there was nobody around, so that was wonderful. Which was even surreal, because I've been to Miami many times, and it's a hopping place, the Miami Beach, and there was hardly anyone. The beach was off limits. It would be $1,000, as far as a penalty. The police boat was just traveling around. They were like checking to make sure nobody goes on shore. There was a couple of boats that they were partying, the young people, the music on in the middle of the rain. And we had a great time. And we were on the Fort Lauderdale. We went through the channels, and they were actually, some of the restaurants, they were actually opening. And this is last week. So it was good to see some of these restaurants. You have to book way in advance, but it was not as busy. But yeah, the things seems like they are moving. There are obviously concerns still, what's going to happen. And before I go talk about the markets, there's still, from the economy, I still have concerns, because I see there's still disconnect between the stock market and the economy as a whole. But I had mentioned before, you cannot discount the power of the Fed, all the central banks, the liquidity, and we'll see why. That's very important. The second thing is, from the economy, is basically there are quite a few people who are making more money on unemployment. I noticed that even when I was in Florida, and I've noticed some of my friends that the employees don't want to come back. They rather be, collecting the full amount of the employment, which by end of July will be completely done. So those are some concerns I have, that, what will happen after all this money is done. My third concerns about the economy is mostly around the restaurants, small businesses. As you know, majority of restaurants, they're in a low profit margin, and some of the major chains, they've been doing the takeout and the delivery. Companies like Chipotle there, or Domino's Pizzas and Papa John's, they're doing fantastic. The growth has actually, they've had actually more growth. but some of like sit-in family-oriented businesses, especially again, their biggest profit margin comes from the drinks and comes from the bars, some of these restaurants. And till we have that social distance, until we have the people coming in, it's going to be very difficult for them to get back on their feet. Projection is by end of this year, we will have about 30 to 40% of these restaurants going out of business, because although they get this stimulus check, they did get the PPP, majority of that money was really paying for the payroll and maybe rent. Now, if they want to go back on their feet, they need to restock a lot of things, including the food and beverages. And where is that money going to come from? So I want to throw this because we're talking about flying, which is, I'm glad, there's a flying going on, so there's more confidence. And last week we did talk about airlines, which I will talk more. So in reality, that's what, there's a couple of things that I think end of July we will have, or June, end of June and July, the reality might hit us a little harder than what it is now. But it's summertime. It's wonderful that a lot of things are going on. As Chris earlier mentioned, she's excited that the restaurant's gradually opening. It's nice to be able to get a haircut. But on the other hand, how fast people are willing to go back. Henry and I were talking about the club soccer. It's starting gradually. But there was a lot of damages are done in some ways. So I mentioned last week, again, I'm positive in the sense that because of the spirit we have, the entrepreneurship and creativity. On the other hand, when the government puts its nose too much into things, when people say, well, I can make more money if I'm unemployment, or if my business is dying, government is going to save me. Sometimes we kill that entrepreneurship. So there's a balance here. And my hope is we go the other way with all the technological advances and great minds that we have. People will realize that no, there is hope, and there is light at the end of the tunnel. But we also cannot close our eyes to the reality. I go back to mention the club soccer. I mean, what will happen to Chuck E. Cheese's of the world when those places for the birthdays for the kids? I mean, how soon people will feel comfortable? So there's a lot of emotions involved in this. And then we think about Brazil, we think about South America, or Southern Hemisphere with the winter starting, or the fall ending gradually, the winter will start. So those are some concerns. So we will discuss that more as we go through the market. So you've been with me for the last few weeks, and I thought it's very important to differentiate between the trader versus investor. And the reason I say that is, again, as I'm meeting with more, right, when I work with my students and other people, sometimes these things are mislabeled. So I thought it might be timely to make sure we know when we are putting our money in the markets, what are our purpose, the goals that we have. Because when the markets go up, it's easy, easy money, and then it's when we make money, things all look good, and we feel like 100 million. It reminds me again on internet times when everybody was making money. But you have to know when you're getting in the market, are you approaching this as a trader, or are you being a long-term investor? The minute that you're a trader and then you become investor, you've lost it. Because when things commingle, and I will explain why, then the idea that you had to invest that money will go out of window. And that's what I've mentioned many times, and I still do to this day. I still go back actually to my journals from 25 years ago. I want to know what was the reason I got involved. So if I got involved as an investor, then the short-term volatility shouldn't hurt me. But if I am a trader, then I have to be on the ball. So I thought it would be timely if I just explain what is a trader, and what is an investor. When you think of investing, the first thing comes to your mind is Warren Buffett, right? So this is the Oracle of Omaha, one of the most, I think, wealthiest people in the world, who made his money really on investing. He had this passion. He had found the value. He became actually really buying businesses rather than their shares. So Warren Buffett is a very good typical investor who thinks beyond, next 30 minutes, next day, next week, even next month, next year. His biggest saying is when he buys something, it's for his lifetime. Although airlines will disagree with him because, as you know, a couple of weeks ago he came and he said he's out of all the airlines. But anyway, he has this long-term objective. My hero is John Templeton, who is the first ever real person who started investing globally in 1950s. He started actually investing in 1930s. He found bargains during the Great Depression. He borrowed raised and borrowed $10,000 and went and bought like 100 stocks at a very low cost. And he said, I'm going to hold on to them for many, many years. And that's how he made his fortune. And then when the Japanese markets were in 1950s, rebuilding, he was one of the first ones that he got involved with that market while everybody was making fun of Japanese market. So basically, these two are typical investors. When we think about trading, on the other hand, people who take advantage of the movements of the markets on a short-term basis are the biggest one I can think of is one of the most famous ones is Jesse Livermore. He made his fortune, if we translate today, is in billions, what he made and lost. He was doing, they used to call them bucket shops, and he would go put the money, they weren't like really brokers. And he would read the ticks, he would look at then the ticker tapes came, and then, he was looking at that. So he went broke 3 times, but he made, as I said, in today's dollars, billions. George Soros is famous for the man who broke the back of the Bank of England. His famous trade was obviously shorting the British pound. And they were, supposed to join the euro. And so he's one of the wealthiest men in the world. And Paul Tudor Jones is a great hedge fund manager. In 1987, when the crash happened, he made tons of money in that day. He made 6 or 7 million. This is 1987. Young men. So these people, they look at the inefficiencies in the market and they take advantage of that. So in a sense, I thought just give you, if you want to do some studies on your own and see who are like the traders doing, and Market Wizards is one of the best books you can find out by Jack Schwager. That's one book I would definitely, if you are really more interested in understanding, let's say, futures, the psychology, the options, currencies, that's a great book. But yeah, I would recommend to have this book in everybody's library, The Reminiscence of a Stock Operator. And this is supposed to be the life story of Jesse Livermore. And you will learn about the crowd psychology. You will understand how he was thinking, and he ended up committing suicide, actually. He went broke, but it's amazing lessons from the way he was thinking, from his cotton trades to stock trades, shorting the market in 1929. What went to his mind? So it's not a big book. Sure, if there's the DVDs available, I think you can even get it for free. So I would definitely, if you want to be a trader, but even as an investor, it is a wonderful book to read. So what are the traits or characteristics of the traders versus investors? The number one, for me, is the priority is the time horizon. Most of the traders, they look at the short-term inefficiencies. They want to jump in investments. I've shown you something. I know this year, like a couple of months ago, I was in a trade for 6 seconds. 6 seconds, and I was in and out, and I've had the 20-second trades. And so basically, we look at noise in a sense. So we, as a traders, we look at a very short term. We have a specific objectives to make quick money and be out of the market. Obviously, investors look at more of a long term. They're not looking at what is happening with the volatility of the market today or tomorrow. They will look at the long term. The objective for the traders are mostly making quick income. So when you go in, you're happy if you made $100 on the trade or $300. And now with like really no commissions trading, it's made it a lot easier for the people to become really traders. But the majority of people, they are investors. And the whole objective is to create wealth. So it's not the daily in and out and spending the time with the markets. They rather be in the markets for a long haul. As far as the risk profile, because of the nature of the trading, most of the people there, when they're involved, they are more of a risk takers. And that's a danger when it comes into the picture. And I had to, again, last week when I was talking to the person I was with, it's like very aggressive. You know, he's a poker player. He loves adventures. He's like, he was looking at, so I would do 4 contracts. He wanted to do 40 contracts. I'm like, you know, you have to have your risk management. And so that's what happens is the risk management becomes a lot more important when you're trading, especially we will talk like when you do futures, even in options, but in the futures, it is all about controlling risk. When you're an investor, you're more of a less of a risk taker. You're more of a risk averse. You like to have the consistency. So basically, you look at the long-term projections, and you know, you've seen the returns of the majority of the markets in the past. If you have a nice diversified portfolio, these ebbs and flows go away, and you, in the long run, you can be profitable, whether it's real estate, whether it's stocks, whether it's gold. So each one in the long run works out. So more people who are invested are risk averse. As far as the volatility versus stability, obviously traders live on volatility. They like the volatility because that's what makes the price movements. As an investor, you like to have the stability because you want to have the trends. From 2009 to 2019, majority of markets, obviously, they did very well, especially in the United States, from S&P 500 to NASDAQ. Really, as long as you followed the trend, you were a long-term hold. It was more of a buy and hold. You did very well. From a trading point of view, we really didn't have a lot of volatility. I mean, last year was very difficult in a sense because the volatility was so low. So if you're a futures trader, you really like to have that movement so you can make quick money. And there are times that, you know, in 1 month, you can make as much as a year because of the volatility. The types of analysis this is general. I'm not talking about, you know, it's 100%. Majority of traders, because of the short-term objective, they look at the charts, they look at the indicators, they use the technical analysis because they really don't care what the company does. They look at that movement. On the other hand, as investors, you want to analyze the company, you want to analyze the economy, you want to analyze what is the interrelationship with the sectors and the industries and your holding. So majority of people use the fundamental analysis. And that is also, again, it applies in the trading too, because what it is, basically from the fundamental point of view, if I'm trading oil or gold or the dollar, I want to make sure I have the fundamental or a macro point of view understanding. As far as the personality, this is very important to know yourself, because if you're very patient, you're analytical, you want to have kind of everything is planned ahead, then you're more of an investor. With trading, it is quick decisions. You're in and out. You have to make that decision quickly. Sometimes it's like a more of an alpha personality involved. So that's another thing you want to consider. Now, with that personality comes a stress level. So when you're a trader, because of that movement, the volatility, what happens, the stress level is much higher. When you're investors, because you know in the long term you're gonna, basic looking at the history, you really do not follow the markets every second. You don't look at your phone and you don't look at your, what the stocks are doing or whatever investments. Then you're more of a patient person, so the stress level is generally low. That takes us to the tolls paid to markets. And what I mean by that is you hear the stories that 95% of the traders, they lose their capital and they're out of the market. They don't make it, usually like 1%. And this is in the long run. Because if you're a trader, you want to approach it as a business owner. It's actually a business. So what they do, average trader, I just tell you, especially in the futures, they go through their accounts 3 times. What I mean by that, they start one account, they take it to ground, the zero, they do it 3 times before they really learn how the markets work. So they pay a high tuition. On the other hand, if you're an investor and you've done some, you've done your studies and you've done your analysis, then really, you're patient. So you really don't, the markets doesn't take a lot out of you as long as you have that long-term horizon. As far as the information required, obviously, because you're looking at the short term, you need the real time, the news and data. You want to make sure it is available within seconds. Your internet, your operations are up to date. Everything is working. Believe it or not, I have 6 or 7 accounts, but I also have a telephone line just in case if there was some problem. This old telephone lines back, especially when I had my office, I had multi-monitors. I want to make sure in the middle of, let's say, if I have a trade and then things break down, internet is not there, I want to have backup plan. On the other hand, information for investors is more of a fundamental. So they are, again, being patient and long-term oriented. They don't need access to the real time, not most of the time. The types of investments for the traders, majority of them, because they're short-term, they are really, they like to use the markets which are really move fast. And that's like futures market, options, they do Forex, which is currencies, they do stocks and ETFs, just because of the movement in those. And if you notice, majority of these are on margins. What I mean by that is borrowed money. So they come, let's say they have a capital of 25,000, they're controlling 250,000. So they are really basically on a borrowed money, majority of the traders, because that's what they're betting on, is margins. On the other hand, investors can invest long-term or even can be intermediate term in stocks. They do ETFs, options can be used. It can be used as a hedge. And then mutual funds, which are some of the favorites, and then real estate. So that's obviously another long-term investment. The last but not least is the taxes. So again, I put down for traders is high and low, because first of all, as a trader, you can actually set up, you can make it as a business. And because of you doing a lot of short-term trading, so what happens, your stocks, if you're in it for a day or a week, you have to pay ordinary income tax. On the other hand, I put down low, because it's a business, approaching as a trading, it is, some of the things you do is tax deductible. For instance, if you pay subscription or doing any type of educational, buying materials or doing any type of educational seminars, then they're all tax deductible. But the other thing about I put down low, when you trade futures, in the futures trading, whether you hold it for 6 seconds that I mentioned, or a day or 6 months, 60% of that trade is considered long-term automatically. only 40% is taxable as an ordinary income tax. So a lot of people who invest or the trade futures, they really like that portion of that. Also, just a side note, when you do futures, from the accounting point of view, you could have done, I've done actually, it's like 5,000 or 6,000 trades in a year. Your brokerage firm, they send you the 1099, but it's only your basis and how much they just put the profits. That's what IRS gets. But when you do stocks or options, now if you get a 1099, for instance, from 99B from like TD Ameritrade, when you talk to your accountant, you have to itemize on Schedule D. So it's like time consuming, and obviously your accountant gets rich on that. So those are the things that a lot of people like that portion of because trading futures. On the other hand, as investors, obviously, because you're generally long term, then anything over 12 months, and then because 12 months, 1 day becomes long-term capital gains. So the taxes become less of a burden than, let's say, short term. So, Sean, can you do me a favor and maybe mute everyone so that I hear some noise? So, thank you, Sean. Thank you. All right. Next, I'd like to share again the trades of the week because I think there's always something we can learn from them. These are real trades and actually happen during the week. And I'm hoping they're useful for you because I look back and I want to see if I made a mistake where it was. I like to analyze them over the weekends. And again, the last 2 months, there haven't been a lot of mistakes. So it's been, but believe me, there's a lot of mistakes that I make. And I learned a lot more from them. So I thought to share one trade in options I did. This time it's an individual stock. And I bought a Boeing June option, only one. I put 5 in and I immediately got out of them because I had made a mistake. So one of them got stuck. So I broke even on that one. But just to tell you, this is humbling experience. I put down, we were going on our boat trip or something, and Boeing came with an, they're gonna go back for the 737, and the news was out there. So instead of buying the June 19, 148 call when Boeing was about at 146 or 7, which is right here. So so I bought it. So I was planning of buying it here. When I pressed the trade, by mistake, I put down sell the options, which means that I was collecting the premium, and which would have worked out in a sense because the market, it did go up. So either way, it would have been, I'm sorry, it sell the premium call. I thought I was put. So that meant if it goes up, man, I could be assigned. It was a naked call. So thank God I noticed it immediately. So what I did, I covered. Thankfully, it went down, so I didn't lose any money. But mistakes like that happen, so you double check. And so that was 5 contracts that I put in, and immediately then, lo and behold, some reason I had done, whatever happened, I bought one 148 contract on Boeing, and it was at $9. And then the next day, the news came with that Boeing about the layoff. And usually that's a good news, but I usually have a pre-plan. I'd like to make minimum of 25%. I usually like to put multiple contracts rather than 1 or 2. This time, it just for some reason, because of the mistake I made, it was only 1. But because I felt there was a euphoria, we could have, this is as you can see, it's a 5-minute chart. So it was a double top. The candlestick turned red. So at this point, I sold it for $14. And I think another reason was we were going out on another boat ride. So I just wanted to make sure I'm out of it or something. So basically, there was got lucky in a sense. But also, I looked at the charts. And also, I felt this is a lot news driven. Fundamentally, Boeing's still not there. Granted, they won't go broke. We basically that's what I covered. This is the chart of the Boeing. So basically, this is Friday's close. So my timing was good. So that was the reason for buying Boeing. In the meantime, I had recently, this again last week actually, before I went to Florida, I bought shares of this is Genesis Healthcare, and what Genesis is, it's like more of a COVID. It's a medical equipment, COVID related. I had looked at them before. There was more of a fundamentally something was going on, and I thought that's a good time. So it's like around here I was studying them. This is, if you recall, Ichimoku Cloud. I kind of magnified it. This is for the day, so you can go back to your last week's charts and see how, let's say, stock charts has a really nice one. And if you recall, usually when it's under the cloud, that's negative. But when things turn around, your first resistance usually is the bottom of the cloud. And the bigger the cloud or the thicker, the more resistance you have. So it's not like water, it's more like oil. Now I was watching that. So this is called standard line and trend line. As soon as it broke above this, these are not moving averages, by the way, but I mentioned last time, these are more of a look at the high and low of the last 9 and 26 days. That's what they look at. But anyway, I put a buy right here. This is actual stock. So I bought 5,000. And as soon as we broke above this lower part of the cloud, I immediately put a sell target. So I always put my loss limit so if this is the candle I got in, the low of the previous day candle is my loss limit. So or my stop loss. So this is how it works. And if you do trailing stop, so every day, if it's the case, either you can use percentage or you can do it manually. So if I'm on this day, I put the low of this day. If I'm on this day, I put low of this day. But because I had a target, once we broke this, I put a target right at the bottom of this cloud. I mean, the top edge of the cloud. And I wanted to see, I had actually put, later I put sell some more, but it went above the cloud, the edge, and it closed inside. Since I sold 2,000 shares around 128, between 120 and 126. So that's where I got rid of some of my shares. I still hold some. But look what happened the next day. Tried to break above the cloud, but it failed. And there was 1, 2, 3 days, and we have now broken below this at the lower edge. So it was more of a news driven. We had like sector rotation, which I will talk to you. So what happened was this was more of like a penny stock, really. I bought it at 74 cents and I sold it at 128 within 2 days. But the markets respect the, believe it or not, but these indicators. And basically, this was more of, again, I knew what my tolerances and what is my target. So that's how I got out of it. This is on the stock chart. So you can see exactly where the 200, and we've talked about the moving averages, the 200-day moving average, as soon as it broke above the 20-day, we've talked about, which is important. Look at the distance between the price and the 200-day moving average. Look at the distance between the 20-day and moving average, and how quickly it kind of rebounded. That was like too quick, like a rubber band. So the fastest they go up, the faster they come down. So as soon as that's interesting that 200-day was 128, and that's what I sold half of my, most of my positions. Now, let's see what happens this week. You can see the volume was very high going up, and now we're coming down, and let's see if we will find support at 80 cents. But I'm watching that, so we'll see what happens with that. I did another trade, and that was the Tuesday when the markets open, I majority of the news I've shared with you last 2 or 3 weeks that a lot is happening after markets, which is like overseas or when our markets are closed. There's a lot of movement, so I'm pretty cautious about that. So I take it with uh, uh, again with consideration that maybe the movements are not as credible as they should be. So this big gap, I bought a put on May 29th, which means yesterday. I put 300 because I felt, first of all, 3,000 we have talked before was a major resistance. And we tried to break it first time, second time, but we'll talk about markets. We finally broke it, and I will discuss that. But I knew usually the first time when we hit the resistance, we come down. The second thing was there was this massive stimulus package that in the European Central Bank, they dumped $750 billion helping the economy, which they still think is not enough. So and Germany will have its own. So there was a huge movement before the markets opened. With that in mind, again, I knew it's like the 300. So I bought some puts. And again, I have my limits, so I just got out of them. I also, with the casinos open, again, you don't want to be greedy. So I always like to take some profits, regardless of how much I believe. It's just my nature. Maybe that's what my difference was with, the person I was with last week was, it was, I would buy, if I buy 4, he want to buy 40, and he would be very successful. Imagine, making quick money in a matter of, I think it was like 25 minutes. So that was a win story because they're the first casinos open. Then I also did some of the Dow Mini futures. This one was a break even. I lost a little bit of money, but you can see how quickly I'm in and out. I just, because look at the volatility, I was losing money. I didn't put the stop loss because I believed that my objectives, and that's a dangerous thing. So I don't encourage you doing that, but sometimes you have this hunches and you go in there and you believe that it's going to hit because the markets are so volatile. They will hit your target. So this is what I did with this Dow Mini. So talking about that, let's talk about the markets. And I mentioned to you again that it seems like there's a good reason. There's the separation of markets and the economy as a whole. Eventually, the consumers have to make decisions what they're going to spend on. So, as every week I go through this studies, on the weekly studies, I wanted to see initial jobless claims. They're still high. I mean, every week has gone down. It's not 6.2 million, but that's still continuing. The retail sales, on the other hand, some of them are opening, but this also takes into consideration of online shopping. And then the box office, what I look at it compared to last week, you can see we are up 40%. So that's a good sign. So people are feeling a little more comfortable. The rail car traffic is very important to me. So you can see there's movement there. The steel production, on the other hand, month over month, we are at the low end of it, or we are negative. Week over week, we are up. The hotel occupancy, again, I look at the trends. So more hotels are opening. When I was in Florida, there was, like I saw Hampton Inn and a few other hotels, the cars were in front of them, so people are, they are moving in, the prices are more attractive, so they are obviously taking advantage of that. And again, the weekly, it's a little laggard here, so this week will be probably a little higher. The revenues per room. Again, I'm looking at what is month over month and week over week. And then TSA, it's interesting. Well, obviously, was kind of a little surprised first because it's down compared to last week, but then it was a Memorial weekend, so you have to take that into consideration. There was a lot more traffic. And then the month over month, obviously, you can see things are moving to the right direction. And then the gasoline, you can see, I'm sure you have noticed there are more cars out there. There are even some traffic. And then driving on 95 highway in Florida, you could see there was a lot of accidents, number one, because of the rain, but there were more cars out there. So this is what I look at as far as week over week and month over month. I also thought it's interesting to see, it started in China, and they were way ahead of us. So how they're doing, Goldman Sachs does this study of activity tracking with the consumer, because again, the consumer is the driving force of the economy. So this is where we are. It's a little laggard again, so we like to see this thing start moving. So talking about the markets, I thought look at a little bit of the psychology every week. In the past, we've talked about how we, when do we sell, when do we buy? Buying is a little easier because it is, when we talk about trading or investing, I think there are like 3 or 4 major things. Number one, what do I want to buy? So that's a discussion we'll have is, do I want to buy futures? Do I want to buy stocks? What stocks? So the second thing is, when do I want to buy? So then you look at the different factors from the technical indicators. You've done your fundamental analysis and studying, but you look at the classical, look at the chart, and you look at the indicators, like it could be momentum, oscillators. But you also like to look at the sentiment, which is more of the psychological and the crowd. And that's one of the things you want to follow, because it is not only the liquidity, but also how people feel about their decisions. And sentiment plays a role. The third thing we want to do is, when do we sell? And that's the most important decision, because when we sell, then there's always this thing, of the fear of missing out. Did I miss out? The regret? Did I sell too soon? Did I sell too late? It's always these things go to your mind. So you want to have everything, look at all the 4 factors. But when it comes to general market, there are a lot of different sentiments. So there's the AAII, which is the American Association of Individual Investors. They look at what their investors think about. There used to be Investors Intelligence, then IBD used to have its own. And then there's a CNN, Fear and Greed, which is neutral. But I thought this was interesting that the Citigroup puts out and looks at. And look what happened right around March. We were at -3, and there was a panic. So that usually indicates panic, in the sense that that fear is overwhelming. So that's where usually market bottoms happen. We also look at McClellan oscillator and look at the put-call ratio, which I will discuss a little later. And then in euphoria, when it happens, it is some kind of a indicator. Like in January, we saw that, but there wasn't much correction. But in February, you can see something happen. Now we have passed way above the high of February. So this is just one indicator, by the way. So I thought the market sentiment, now we are, and I've said it before, there's a lot of hope. And I can see why. I mean, people, places are opening, there's a positiveness. So, and then as investors, which I feel, again, majority of investors right now, they are not the institutions. That's my personal, it's more of a retail investors. They're coming back. So that's where we are. I just thought I want to share that with you. We're at 0.6. Then there's an investment sentiment trader. They do have some, they come up with their own reading of the markets, and they look at what is the momentum and as far as where the market is. Now, when it's -200, this is the momentum of the market. That's like extremely low. There's a lot of fear. So that's usually bullish. So it's time to take risk. When like extreme 200 positive, that means the momentum is very strong, which in the short term is positive, but it gives us the caution. So what happened, you can see this is where we have been. So, I mean, you have access to all this, by the way. I hope you can review it yourself. So this is where we were in, believe it or not, in February. So March lows happened around here, believe it or not. So in February, we were having a little warning, which was going on as far as the euphoria here. But these are laggards. So even if we are here, it might take weeks before, if there is any turnaround. So these are just little factors. These are the things accessible to you. Everything that I use, I try to have it free resources, so you will have it. I try to use these so as a guideline, so you can go and check it out yourself. But I think it's important, and maybe Saturday and Sunday, just spend an hour and just go through all of these. You know, the bond market leads the stock market. In a sense, that's what the fear had been, and that's why Fed aggressively made that move. So I thought, just for reference, to see where this is the dollar or the U.S. rates, the short-term rates, where we are. What is the euro? And then we compare that. I mean, where the British pound, in UK, where are the short-term rates, and then this is the yen at negative, close to -1, and then we have euro, which is a negative rate, and that's between this and also long-term rates. You can see as US 10-year notes is higher than British UK gilts and higher than German bunds. So you have to remember that the currencies, they like to go where the highest yield is, and that's why the dollar, last week with the stimulus, the euro got a little stronger, but usually when there's not parity, now we have a parity with the UK and British, dollar and British pound as far as the rates goes. But when there's a big gap, money goes to where the highest yield is, and that's what the dollar was strong. This is the yield curve, which used to be inverted. Now it's changing, going upward, and the credit and LIBOR rates I thought it's very important. I think whatever you do, and I used to tell my students, all of them are excited about equities and buying stocks, and if you don't understand the bonds from the macro point of view, it's very difficult to be a very good investor unless you're trading on it. From the macro point of view, you want to understand what is happening with the interest rates and the bond markets, the credit qualities. A lot of countries, their biggest market is their bond market. It's not their stock market. Bond market is much larger than. And the bond traders are much more cautious. They do a lot of due diligence. So when you invest in a company, make sure that you take a look at their credit rating and the bond rating, because if I'm going to lend you my money, I want to make sure I take a good look at you. So the companies that, they want to lend, they want to make sure the other companies are in a good shape. So that's why understanding these rates are important. Now, as you can see, the corporate bonds, this is March. This is where the danger sign came in, and the high yield, mainly the junk bond. So we were actually at 10%. That meant that all these under BBB rated companies, the cost of their borrowing had just gone to the roof. Imagine, from 4.5% to 10. And that's precisely the time that the Fed came in and decided to buy the ETFs and buy these debts. So brought the risk. Look what happened. We went from 10% to 6%. So it brought the stability. The same thing with corporate, which is, you can see the spread pretty consistent And so this is the yield on the high yield bond is at 6, here around 2. And then the munis, the same thing. Because of the fear of the states, and also the municipalities, again, we had jumped to 3%, but again, with the liquidity and Fed, we ended up being more stable. And if you don't know about LIBOR, it's very important because the mortgages that in all the countries, the majority of them, they really use LIBOR for lending and for any type of a corporate lending, for mortgages. It's most very important to understand. Again, we had the risk in April. And what LIBOR stands for is called London Interbank Offering Rate or Offered Rate. And what that means is the major banks, they kind of lend to each other, and this is the rate that they require. So if the two banks are working together, it could be overnight, and it goes all the way to 12 months. So there's 7 of them. So when you hear this LIBOR, it was, oh my God, went so high or so low. Now that means that the banks, they cannot trust each other, or they don't know what's happening, so they're going to charge the most. So that's why this panic happened here. Again, the central banks came in, and look at where we are now. It's like almost a minus, so because they're looking for stability, and there's been so much stimulus moving in. Let's review the markets for the last week, and this is important because, when you look at on the surface, the markets have moved, and you can see that the markets, for instance, for the Dow Jones Industrial, last week, we were up actually 3.75%, but year to date, we are at 11.06. So because of the 30 holdings in the Dow Jones, we got a variety of things. So you will see we've been a laggard compared to S&P 500, which we're only down now, believe it or not, only 5.77%. But for the week, we were up on 3%, which was lower than the 3.75, and I'll explain why. But this is what I want to emphasize. I had mentioned, in last, since the whole epidemic happened, now the technology has been the leader. And we've looked at the NASDAQ and talking about Amazons and Apples and Googles and Facebooks and Netflix and Microsoft of the world. So we are actually positive 5.76%. We're almost back to you can see almost back to the high. But look what happened. For the week, we were actually lagging S&P at 1.77%. And then Barron's has its own 400, and this information comes from Barron's, and they did very well, and the small caps did well. So I mentioned last week, again, we don't want to just emphasize just the indexes and say, oh, S&P's up. But last 3 weeks or so, I see there's this rotation going on. And if you go back, you can see that, for instance, Apple, last Friday, if you notice, there was Apple, and then Facebook was a hero last week, but there was a little correction this week. Microsoft had a little sale, and so the money is moving back and forth from technology to economically sensitive markets, so which is the financials, energy, and maybe consumers. So what is happening? You will see this seesaw battle. So it doesn't, that's why it's sometimes difficult to say that, oh, this market is doing this, or everything is hunky-dory. So sometimes it's not that the fresh money is coming in, it's just the money moves from one sector to another. So I want to be wary of that. And this kind of also, it gives more emphasis that you can see the large growth for the week, which is, the majority of like NASDAQ, and this is more of a S&P, was up 2.2, but the value took over the growth for last week. Although we are lagging, look at what happened to the growth for the for 1 year, and we are we are laggard for the 1 year over year. For the 3 years, the large value is only up 0.4 compared to 15. But then we go back to small cap. Look what happened to the small cap value. It's up 4.9% last week, although we are down 0.26. So there was some energy, there's some banking. These are that money was going there with the low PEs, some dividends paying. So that's where the money was going. And then the dividend paying, because of the rates being so low, they had a nice jump last week. And then I let you study this yourself. And one of the things I want to emphasize, look at what is happening with internet, e-commerce, internet services. They are the driving force. So we are in an evolving economy in one way of, some sectors die and some sectors evolve. So let's look at, for last few weeks, I've been mentioning that, since April 10th, we've been in a box. This is a weekly, by the way. I thought this week, let's look at the weekly rather than daily. So they've been that energy just coiling in, and I didn't know which way it will go. So, and with this, this is a 50-week moving average. You can see last week we broke above that, and we have, the 3,000 was very important junction. So that's a positive news, because we did have, we broke it, and that's for S&P. But let's move on. IWM is a Russell 2000, the small caps. With Russell, as you know, it has been laggard and it dropped, but then it has been leading this up in a way that it has had the biggest move, although it's behind the NASDAQ and the technology. But we hit the 200-week moving average and we kind of stalled. So let's see what happens next week. The MACD has gone to the positive. I use a slow stochastics. Last week I told you to use a 20, and a few weeks ago I was talking about 20 is like really oversold, and then 80 is overbought, which means nothing unless when they cross it. But usually above 50, 50 itself is like a cross. That means if you're above 50, then the buyers are coming in. You're right around that now at 52. When we are at around 30 or 40, that means the sellers are still in control. So this is a food for thought. This is the QQQ. This is again the weekly. Now you can see we are not, although it looks like overbought, we still, we can be overbought for a long time. Look at what happened here. We are overbought. So don't think that because stochastics is up there or RSI is over there, that means when they cross it, that's when the warning sign happens. So that's when you have to be cautious. The same we're still in a good mode. The only thing I will have, question, we are very close to the high of where we were in February. That might, from the technical point of view, might be a double top. So just be aware of that. If you have a lot of technology, there might be some, again, a little correction. As I mentioned, the money looks like it's kind of moving back and forth. Like Friday, if you notice, now IWM and S&P, we'll talk about financials. There was like the financials sold up, but then look what happened to the technology. All of a sudden those stocks got a new life and they moved up nicely. This is very important. This is the LQD. That's the ETF of the investment grade, and that's what Fed decided to put $2.3 trillion, and this is the time they did it. Look what happened. We came last week. I showed you it hit the 200-day moving average, bounced back. You can see here's the 20-week moving average has bounced back, and we are going back the high of the year, or a high all-time high, really. So this is kind of a leading indicator. There's just flood of money. They're going to keep the liquidity with this credit as far as the credits of these investment grade bonds, the high yield bonds, the junk bonds. They're going to make sure they can help them to survive. So in reality, really, from the capitalistic point of view, this is not really organic. This is artificially, that's what the government is doing. But as I mentioned last week, it's about really saving the patient at this time. They don't care how it's going to look after the patient is out of surgery. So, but this is not really economic result oriented, but rather it is the Fed liquidity oriented. I'm looking at the bonds. So this is the interesting chart. Again, I'm looking at the weekly. I mentioned to you last week and the 2 weeks before, the week before that, is we are in a box. Every single from S&P, you noticed, Dow Jones, we looked at the bonds. I will show you the gold, the dollar. And bonds didn't really drop. Usually when the stocks move up so much, the bonds usually, they like to retreat. They haven't yet. The minute that the bond market really drops and you know the buyers are in for the stock market, we're still in that zone. There's still a lot of energy being cooped up in the bond, as well as, before I go, let me go to this, as well as the dollar. You can see we're still in a box. The dollar dropped a little because of what happened in Europe, but we're still under support. And I will show you the gold. One thing is, it's important to me, we talked about every week, financials are the bread and butter of S&P and IWM. We need financials. So last week they had a nice move, but they hit their resistance, so they retreated. So there was Wells Fargo, I had mentioned, they hit the 22, they have rebounded nicely. But there's Bank of America, there's JP Morgan's of the world. So basically there's a Citibank. So we're still in a box. We're still not out of the woods. We like to see them follow, like S&P broke above, that like the 200-day moving average. We like to see this to lead. So those are the things that you want to follow. Again, these are on a weekly basis. And last week we talked about the airlines. They, we had, since our last conversation, Simenka was the first one, and then we got LATAM, LATM, the Chilean airline filed for bankruptcy. So I mentioned to you some of the strongest ones. So the airlines had a nice week. Beginning of the week, they went up nicely, but then they finished on a week. So this is more of a, we call it doji, and doji tells us indecision. You see there's a big tail, I call. This is a tail or wick, and this is a small tail here. So the buyers really got rejected. So the sellers took over at the price of 55. So that's, if you look at the airlines, as I mentioned, find like the more solid ones. And if you want to buy them, you want to be aggressive. I mean, company like, America Airlines, I think they're still weak. And just be selective if you want to take a chance. But again, we try to cross the MACD, we try to cross the RSI, but obviously I'd like to see it over 50 if it's possible. The dollar we talked about, and this is the oil. You can see we had a great move. As you know, USO, the Exchange Traded Fund, the SEC is going to do an investigation because in the middle of the whole thing, they decided to change their investment policy of the contracts. And that's why I was really cautious about them, is because they were, instead of selling the front month, which is the nearest month, which is the June, they moved all their contracts to July and August. And so it kind of, and then they had the, I think it was 8-to-1, a reverse split. But so oil is right now is against this resistance, had a really nice move. But I would watch, again, I'm more of a advocate of rebuff gas and gasoline than oil. there's a lot of games going on. Saudi Arabia is talking to China, and Russia is playing the games. The whole point, I think, again, Saudi Arabia really wanted to kill the shale. Besides Russia, they wanted to affect the shale industry. That's my opinion. And they probably got kind of succeeded till the Fed really decided to step in. This is gold. Again, visually you can see this is like a accordion. So we are really, the energy is just being saved here, coiling. Gold still has a place. It tells you something, that it's not all hunky-dory out there. People are still cautious. They like to have an insurance, and that's for the gold really, as long as it's staying above these. You see these tails? These are weekly, by the way. So this is one strategy. You always, when you have these tails, that means that the buyers are in control. Every time the sellers came in to sell this, the buyers stepped in. So these can be a very nice support area for you. On the other hand, when you have a long tail like that, the buyers really got rejected. The minute, so the tails for me is more important than just these big candles. So when the minute that these tails, you break above that, there's a lot of energy and a lot of buying power coming in. So for instance, we had a support, this tail here, we never touched it. So this is a big support at 1450. Then when that area is very crucial. But on the other hand, when you have these tails here, once we break it, granted it came down, but then once you break above that, they usually continue. And these are, again, weekly, they're not daily. One other thing I want to talk to you about is the more of the economic sensitive. I look at lumber quite a bit compared to gold. Gold is more of insurance. Lumber is more of an activity of the economy. I want to see how the housing market is doing. Is there demand? Is there? I could see a lot of buildings being built, apartment buildings, but not much residential buildings. Although there were few, in a kind of an exclusive part of the Fort Lauderdale, they were building nice houses by the water, but majority is apartments. So I like to see that activity. So I look at lumber, and lumber tells me if there's any inflationary pressure. So whether all this pumping the money in the markets with the Fed, is it going to be, at least in the short term, inflationary? Until we see the signs of it, right now we still have the deflationary, because we need the earning movement, we need the consumer spending, and the raw material I look at. So as long as we don't have it, so the inflationary pressure is not there. So that's what Fed and central banks are pretty comfortable pumping as much money as they can, because with the interest rates being so low, they know they're not putting a lot at risk, but the balance sheets are just horrendous. So I know eventually we have to pay the piper. And but again, everybody's thinking politics, and as I mentioned, if it wasn't the election year, it probably could have been a little different. But that's what it is. And this is the housing, or the home builder ETF. So you can see we've had a nice movement from the home builders. So they've been active. We are in the crucial point here. We gapped up. So let's see what happens with the home builders. But they have been a nice movement. And the last but not least, I like to look at copper, Dr. Copper. This is again the weekly. We had the resistance, but what happened from the low in March, I believe we had one, Sean, I'm not sure if we saved that recording, if it's there, but we talked about how everything from the monthly point of view, we were so oversold, and copper, like a company like Freeport McMoRan, was like at $4.82, and then it's up to over $10. I mean, up 100%, 110%. And look at what copper was. So these are kind of good signs. Still not where we were, but at least we're in the right direction. But I want to follow this to see if there's real economic activities for real. The last but not least, I want to show you the Fibonacci numbers, and basically we are at, you can see that 50 and 61.8 is important. I know we are running a little late. My apologies. I know we talked I talked a little too much in the beginning. So just the last thing, sometimes if I find it interesting, I like to share what is the next week you can look for. And Zoom, which we are on, they have their earnings, Campbell Soup, and the DocuSign. These are, and Work. Most of these are really more of a COVID oriented. So it would be interesting to see how they are faring. So, and with that in mind, that's, I think it's time, it's about 3:40 California time. So we are, I'm hoping that you find these informative, and I'll, as I mentioned, my whole objective is again to give you the tools that you become independent. And the bottom line is we want to all make money. So that's the goal. And if we can do that, that's the best day for me. So Sean, we are available for any questions. I don't know, let me check to see if there's any in the chats. I don't see anything on the chat. So please feel free to unmute and go ahead and ask any questions that you have.
I mean, I have with the Fed buying the iBoxx, the corporate bond, it was revealed this week. Would you just say that that's a good investment, since the government are actually buying that bond, and it's I mean, it's highly unlikely to fall?
Correct. Well, that's what I share. Like this week, I only shared LQD. So there's the three major ones. So the way they did that, Martin, legally, a central bank, which is supposed to be an independent organization, they cannot just come and buy a fund or stock or whatever. So what they have done, they actually allowed
BlackRock.
Right. So it actually goes to Treasury, because Treasury is part of the government. So Fed is really kind of lending or giving the money to Treasury. Now, Treasury is the arm of the government. Now, they can decide what they want to do. So if they come and directly buy it, then they own it. And that's what happened in Europe. For instance, they're taking over, like Germany, for instance, this week. They are coming, and what they suggest that we will buy your bonds, but we are a 20% equity holder. It's almost like Shark Tank, really. That's what the governments are becoming. So and Japan has done it for many, many years, and they actually actively buy the ETFs. So in the United States, the BlackRock and PIMCO, but mainly BlackRock, they have chosen their three funds, which is the HYG. And yes, I mean, the Thursday when it happened, HYG, and then JNK, which stands for junk, JNK, and then LQD. LQD is the largest, and the reason I look at LQD, which is very important, because they're investment grade, and investment grade means that BBB and up. So when it's BBB and up, it's a good quality. So like if I'm a mutual fund and my investment policy says you only can invest in investment graded bonds, then I will buy these bonds. The minute that BBB becomes BB, then they're not investment graded bonds. So what happens now, all of a sudden, some of these companies, they completely get out of the radar, so that there's no liquidity for them. So what basically Fed decided to do to keep these companies afloat, to keep their BBB rating. So that's how they survive, because now the mutual funds or institutions can buy them. So that's what LQD is the most important, and it's kind of a leading indicator as far as what the equity markets will do. But you're totally right. I mean, J and K, and for the longest time, we always looked at the HYG, high yield bond, and what happens if the corporate bonds are doing well, that means there is confidence in the economy that these with the low credit corporations, the money can, it's finding its way, they have confidence. The problem right now is, it's not the confidence of the economy in these companies or the ETFs or these companies, is the Fed's liquidity. So we don't know. I mean, the water is really murky. I mean, there are fish out there. We cannot see it. But I'm not going to dive in there to find out if the shark is going to be right behind me. So this is not really organic. And what happens is really we are at the mercy of the liquidity of the, and this can go on because they've said, and Chairman Powell has said it, they still have more tools. So they're buying in the municipalities. But yes, that is, I mean, LQD or JNK and HYG, you can follow that. But right now, I mean, they're happy as long as, you know, we're over the 200-day moving average. So it all depends. If it goes down, then they will come back and put more money into it. So right now, they keep the things afloat. But you're absolutely right. You know, just, I've said it, you know, we cannot fight the central banks. I mean, my outlook was based on the history, and it still might happen, but it's a lot more difficult to go like the low of the March with like S&P and definitely NASDAQ, because they have their own real market. Once you pass that 61.8% in Fibonacci and we go farther and farther, it's a lot more difficult to fall. But there are a lot of sectors that are out there, they're still hurting, and that's, a lot of them might not even be afloat. So that's why I mentioned the XLF, the financials, and then even Dow. You know, Dow was up and down because of like Boeing. And then you have IWM, the Russell 2000, they are right in there. So if they fall, they have a good chance. So you have to be selective. But yeah, I mean, there's that liquidity. And I guess a few weeks ago, I started our meeting and said, you know, just trade what you see, not you wish to see or what. So we can. I mean, ego is outdoor. If I'm wrong, I'm done. My whole goal is to be profitable, get in, make money. Nobody gives me any grades. It's not like nobody's going to give me a certificate. Ramin made the greatest prediction 99% of the time, but he's broke. So the idea is our job is to make money. And that's where we are now. So the long answer to your short question, Martin, sorry about that. Sure. Any other questions?
Ramin, this is Siamak.
Yes, Siamak.
A quick question. Can you just go over a company called Zscaler, symbol ZS? They had earning reports last week, or just what you see or how you see it.
Okay, that's
before.
Right. Chris, should I ask you to answer? But
I love Zscaler, and their projections are so strong, and their earnings beat estimates by, well, 2 to what was estimated as 7 cents. And then they purchased or acquired a new technology company that is very, very strong, and the earnings outlooks are just very, very, very outstanding. So I think the markets looked at what they've been doing and what they expect them to do after they purchased Edgewise Networks, and just their increase in earnings are making the company a very strong company.
Thank you, Chris. Yeah, so follow up on that, Siamak, it's, again, these are the technologies, we call them COVID, and the numbers are just going to get better. It's the valuations out of so you cannot be right now from the fundamental analysis. I mean, you got to put the PE ratios to the side. The thing is, after June, you know, with the new earnings coming, a lot of companies are going to look really bad because we still haven't seen the effects of what has happened in the last 2 months. So those are not, you know, when the earnings were coming out, they did not take any, it was like maybe 80% of normal and maybe 15 to 20% was the effect of COVID. This time the earnings will be completely different. On the other hand, then you look at companies like in the technology from the cloud and securities, and then you look at the digital. You look at Docu. It's coming up like next week, as I mentioned, Zoom, with the Zoom and Docu and Work, and so these technologies are just going to get stronger. So that's where the money has been going in, and that's why like the ETF that we have talked about, the like cloud, which I've owned it since beginning of March. It's like CLOU, or the sensor, or there's hack, there's there's the game technologies, and so these are going to get. Just watch for that. And one thing I will say, Siamak, this is a really good time, and that's very important for all of you. I had made this comment a couple of months ago, and I say it again. The markets, this is going to be a really stock pickers. And that's what I think we are together for a timely reason. The better analyst you become, the better finding of opportunities they become, you're going to beat the markets, because we really have two markets right now. And it is not going to be blindly just going to something, even with the sectors you can see, but even exchange traded funds, you can find some of the themes. And if you stick with them, you will make, could be a very profitable year for you. As a matter of fact, one of the things like the beauty and shop we had talked about, like the beauty is like now they're getting really strong. I mean, people were coloring their hairs at home, and I mean the margins are getting much better, while you would say, well, people are not going out that much. So you have to be selective, and companies like Zscaler, and we'll see how the Zoom does, and DocuSign, and then you look at Work, and a lot of them, they're going to be big winners. One last thing I say, and I will do this next week, is about month of June. Month of June is a very important month. And just give you a hint, it has been the best period for the technology starts from October, and actually it ends in June. And that's what people say, buy, sell in May and go away. Because of the strength of the NASDAQ and the technology companies, this will continue. So usually the other companies, that there are going to be some bad earnings coming. And what will happen by end of June, and you have to be prepared for that. So I would say from middle of the June, come do some analysis on the really good technology companies, because what's going to happen on June 30th, a lot of fund managers, hedge fund managers who had an awful first quarter, they have window dressing. And what happens end of the last day of the month, but especially last quarter of the last day of the quarter, they want to be proud owner of the winners. So you look at the relative strength of some of the big winners during that time, and then these managers, they don't care when they bought it, as long as it shows on their fund annual report or quarterly report. They just tell clients that, oh, we own Shopify, for instance. We've had it, we own Facebook or Apple, or so. If you can be selective, usually end of June, these companies do well. July is another story, because July, you're going to have all the earnings coming up, and I don't know how good they are going to be. So stay with the strength, stay with quality. Last few weeks' movements have been based on, again, I keep saying, it's a lot of hope out there, and a lot of money has gone to some of maybe low quality or some of the really beaten up companies. So just be selective. And I think in the next 2 weeks, you have the opportunity to find some good bargains out there. And again, as far as a whole, the market, I think there's a separation of the actual economy, what's going on, and the markets. But again, you cannot fight it, but you can make a very profitable, rewarding, investments in the next few weeks, definitely. So,
I do have one question on Zscaler that I just pulled up FinViz again, and the ROA, the ROE, ROI are quite negative.
right.
And I don't quite understand, or know how to explain that or know if I should worry about that.
Well, the good question. So remember, with these young companies, what happened, they started with um, because of their young, a lot of these earnings that they project takes into account that you look at the 12. So what you're looking at is a trailing 12 months. So as the quarters go, you're going to have a lot of improvements. And that's why, like you look at the PEs and other things, even the price earning, and then you look at the growth, you want to look at the future. And that's why the market is pricing these so way out of whack sometimes, but they know the potential is much, much higher. So for ROEs on these and return on assets, let's say ROA, they haven't taken into consideration of the future. And that's what the market is discounting right now as far as those go. So with the growth, really young growth companies, sometimes initially we can kind of overlook it, but once they become a little more mature or they have a little history, then those are important because we want to make sure what they're doing with the investors' equity, for instance. So does that answer your question, Chris?
Yeah, yeah.
Okay.
Thanks. That
All right.
makes sense.
Okay.
I
All right. You
do
got.
have one more little question.
Okay.
Just on the charts that you were showing on the bond market, I was looking
Yeah.
up under the stock charts and I couldn't find charts that looked like the ones where you had the real heavy
Oh, the dark ones?
yeah.
Oh, those are my apologies.
Yeah.
Yeah, most of when they're white, they're stock charts, but these are from TradeStation.
Oh,
So
from
this is,
TradeStation.
yes. So
Okay.
this is TradeStation, and obviously I think, and I looked at, so last
I
week
could
the
get
friend I
this
had was
in.
that he had Fidelity, and as far as charting goes, I don't think there's any company. If you want to do multiple trading from options to futures to equity, they used to do the Forex, and the charting is the best in my opinion. Thinkorswim has,
I liked the one, yeah, I can do this in Thinkorswim, but the one I
yes.
liked was the one with the four, just, I can't remember if it's either before this one or after it, but it has real thick. It looked so easy to read. There,
Oh, this? Oh, I don't
the
know.
one with four of them. But I must have been similar. There.
Oh, this. Oh, sorry. This is from Barron's. I'm
Oh,
like,
okay.
yes, so we can do that. I mean, you can do
Okay.
lines and you can make it thicker. Oh, absolutely. It's very easy to do. You can change the color, that you make it styles, and yeah, those are very easy to do. You can have 4 charts, you can have 16. And Thinkorswim has a very good TD Ameritrade. Once they bought that Thinkorswim, they made a really good investment. So there's a lot of good studies on that. I mean, I can just like the whole week I can spend on just Thinkorswim, the things you can do with that. But TradeStation for me is my favorite, especially if you're a futures trader. I also use Infinity for my trading, and Infinity does, it's a great dome it has for the trading. But charting wise, there's nothing comes close. And one last thing I would say, if you have any type of, again, platforms, you want to make sure is, again, especially if you're a trader and you look at futures, you want to make sure it's executed immediately. And again, the TD Ameritrade and Charles Schwab, but specifically TradeStation, they don't go to the third party. They execute things themselves, so it's much quicker. It might not make much difference when you're investing, but when you're trading and markets are moving so fast, it's like microsecond. So that's what is important, to go directly to the exchange rather than having a third party. So those are things to consider if you are really heavy duty in trading. So anyway, okay.
Thank you.
All right, you're welcome. All right, it's almost 4 o'clock. So any other question? Sean, yes.
Ramin, I don't have a question. I just want to use the last few minutes
Yes.
to share with a little bit of, basically, I think I'm going to send an email following today's seminar. Because we have been having this seminar for 2 months from April and May.
Okay.
And we are running these seminars on the Zoom cloud. And every month there's a $40 fee. So we are in a deficit of $80. I will send an email with a donation. So it's not a request, but anyone who want to donate suggested $5 or $10 can do that. So we can cover the cost of the previous 2 months. And also, Ramin at the beginning mentioned in the future we might have a subscription. We have more professional. I think we might have a separate Zoom account and provide more stable service. So so it's a good wrap up at this time at the end of May. So I just want to let every attendee know, and thank you very much. I will follow up with the email. Thank you.
All right, thank you, Sean. Okay. Great. Any other questions? Anything? And if not, let's.
Can I ask one very quick
Please,
question? I hope it's going to be quick.
Sure.
Do you have any special strategies for earnings season?
Oh yes. Oh, there are many, Hamad. So, and it all depends on whether you're like option trader or a stock trader, and it is there's a lot of little things that a lot of companies do not let you know, but the markets tell you. So yes, there are quite few, and I think that would be a good class. So we won't have much. So the earnings season really just ending. I mean, we still have it, but it will start in July again. Majority of the companies come out in the first 2 weeks. So we definitely we could have actually special class, could be a 3-hour class on a lot of different strategies you could use to take advantage of the earnings. One thing I will tell you to share with you is do not go in front of the freight train to try to predict by like buying something right like 30 seconds before, 30 minutes before that the stock opens. I mean, a stock closes and then the earnings are coming out. So you want to be, sometimes it's good to miss the train and be on the train, which will crash. So that's one advice I will let you know. Usually a lot of people, they try to be away for at least about a week. If they play options, they start the options 2 or 3 weeks before, and then they get out of it like within the week before. So, and then they evaluate the whole thing and start seeing the day after. So I don't know if that, but yes, there are many strategies. We are not really in a complete earnings season. We are over it, although they are coming out. But yes, there's good ways of making money for the earnings season. Yes. Okay.
All right, thank you.
You're welcome. Okay. All right, it's 4:02. Again, I really appreciate your patience and your attention, and I hope you find them helpful. And I wish you a wonderful week ahead. And I'll see you next Saturday, the same time, same station. Have a wonderful week. Thank you, everyone.
Okay, thank you so much.
Thanks, Ramin. Have a
Thank
good
you.
one.
Thank you. Thank you, Nedajan.
Thank you, Ramin.
Okay.
Bye.